9 deadly mistakes when you're managing your business finances. Hello everyone, and welcome back to another episode at Novarise Invest, your channel for financial education. So today's episode will be all about the possible mistakes that you could be making in your business. In this episode, I'm going to help you identify which ones those are, and if you're making them, then present you with courses of actions that you can implement or take so that you no longer make those mistakes in the future. And make sure you stay towards the end because I have a bonus for you. Before we start, let me remind you to subscribe to this channel and hit the notifications button. So mistake number 1, not having a dedicated business account for your business, okay? And now you might be wondering, why is that important? Why can't I use my personal? Well, if we're going to talk about finances, it's very important that you keep everything, let's say, linearly, meaning you want to have one account that will allow you to easily track the revenue that you're generating or any expenses that you're incurring in your business. And the reason why this is important is not only for your accountant, because your accountant will definitely thank you for that. Otherwise, you're going to drive him or her crazy trying to keep up with your books. But it will also protect you against any liabilities in the event of a lawsuit because you're keeping all of your finances separate from your personal accounts. So we have liability. And lastly, having a dedicated business account will keep everything separated and everything nicely tight and clearly defined, and also separated once again in the event of a divorce and you're going to have to divide your assets between your ex-spouse or yourself, right? So divorce, we're going to keep that in here. Very important. Now, the second mistake is mixing your personal money, right, with your business money. That is a big, big no-no. Uncle Sam does not like commingling. Uncle Sam does not want you to use your business money for personal reasons, and especially doesn't want you to use your personal money for business reason. This is extremely important because in the event of a lawsuit, you're really going to wish that you kept both funds separately, because let's say, for example, if someone sues your business and they're going through your records and they see all the money coming on the personal side and see the money coming on the business side, they're not going to know which is which. And you're actually opening up the door for them to go after both. So on the liability side, very important. Also, as a business owner, it is very, very important that you keep both separated because you want to stay on top of your finances. You want to know which product or which service is bringing you the most money. And you also want to know which expense is costing you the most money. So that way you can take action on either reducing that expense or just simply looking for a different vendor that could provide for a different type of services. Or why not? Maybe purchasing more of that service, because sometimes when you buy more, they give you better pricing and that winds up being cheaper for you. But if you are mixing personal with business, sometimes you don't even know where the money's coming from. Hey, is it coming from your salary? Because I know a lot of you who are tuning in today, that you have a side gig. Some of you are full-time workers and you have a side business, and some of you work for your own business and you receive a salary. But if you don't keep those two funds separate, it is very difficult to know which one is which. So don't make that mistake. And lastly, it's important in the event of a divorce, and I don't think you need me to explain that one for you once again. Okay? Now, mistake number 3, not forming a legal entity for your business. And this is a very big one because if you don't do that, you're missing out big time in many angles. So let's say, for example, in terms of liability, if you don't have your business under a legal entity form, you are risking your personal assets as well. So let's say, for example, I have your business here, right? So this is your business and this is you. So when you create a legal entity for your business, you're actually creating a shield, right? So in the event that someone comes in and decides to sue you, whatever damages they're going after, it's usually shielded by this legal entity. And it will make it a lot harder for them to go after you. However, if you were to have your business under your own name, and not only that, also your personal assets, call it your personal car, your home, everything else, your savings under your personal name, guess what? When they come after you, you're risking everything. Not only you're risking your business, but you're also risking anything that you've worked really hard for. So that's on the liability side. Another point that I want to highlight, it's credit. Did you know you're actually missing on building business credit if you don't have a legal entity? And just so you know, when you have business credit built up, you have access to a lot more capital, which in essence gives you access to OPM, other people's money, and you can use those funds to multiply your business, to expand it, to grow to the next level. And lastly, we're talking in terms of savings and your taxes. If you don't have a legal entity form for your business, you are going to be limited on the taxes that you can deduct from your business. Because remember, when you're running a business, Uncle Sam, the IRS code, does give you incentive for you to take deductions out of it, but it has to be done under a formal business. If you're doing everything under your personal name, once again, it becomes very difficult for you to demonstrate which expense was done for personal reasons and which expense was actually done for business reasons. So you don't want to put yourself in that situation. Hey, well, is this mine? Is it the business? No, you want to make sure that you have everything laid out linearly, nicely under your business. So that way there's no doubt in the event of an audit or in the event of a lawsuit, or it's just simply in the event of you wanted to check your books and see what's working and what's not. And for those who are wondering, whenever I refer to legal entity, I'm talking about legal entities like an LLC or a corporation or perhaps even a partnership. Whatever your attorney and your accountant are telling you that it's right for you, that's the legal entity I am talking about. Okay? Now, let's move on and talk about mistake number 4. And that is not registering your business at the Dun & Bradstreet. Okay, so for those who don't know about the Dun & Bradstreet, it's a bureau that helps you build business credit. It helps you report any payment activities that you have or any delinquencies that you have. Think of it as kind of like the Experian or the Credit Karmas, but for business. Okay, so if you're brand new to the channel and you have no idea what I'm talking about, here's an episode on the side that you can check out after this one, of course, where you can learn more about the Dun & Bradstreet and how you can register your business with them so that you can start building that business credit that will allow you to expand and grow your business to the next level. Now, moving along, mistake number 5, and that is not having assets register under your company books. Okay, so one of the things that I've noticed over and over from business owners is that they typically don't reach out to their accountant unless something is wrong or unless it's time for them to file for the taxes. However, the books tend to be a mess because they are either managing it themselves or they don't have a bookkeeper or they just simply didn't hire the right bookkeeper for them. So let me tell you that monetarily, it can impact you in the long term because what winds up happening, let's say, for example, you have a business, right? And depending on the nature of your business, you might have different assets. Some of them could be fridges, if you have a restaurant, furnitures, right? Because you need chairs, bar stools, and stuff like that. Or if you have an online business, we're talking about computers, or if you're doing YouTube, why not? We're talking about cameras and all that recording equipment and stuff like that. So all of these are actually assets under your company. But if you don't have the right knowledge or the right experience, or if you don't have the right bookkeeper, sometimes these assets get recorded in the books as an expense. Yes, in the short term, it doesn't really make much of a difference because if it's an expense, you're going to take a deduction from your taxes and voila, that's done. As opposed to with an asset, you have to depreciate it over time and stuff like that. But this, it's going to hurt you down the road because guess what? When you go to a bank to request a business line of credit, not only are they going to look at your cash flow, but they're also going to look at the assets that you have. They want to make sure that, hey, in the event that you default or you don't pay them, can they go after your asset? Can they go after your furniture, your computers, fridges, sell them, liquidate them, and then use that proceeds receipts from that sale and then repay back some of the loan, right? And the problem doesn't end there. Let's say you have insurance for your business. I mean, everyone who has a business should purchase insurance to protect your business in the event of a fire, in the event of you having to close down, or any cybersecurity issues and stuff like that, right? So insurance companies, they also look at your assets before they even work on any type of reimbursement that they want to pay you back. You need to have those in your book so that way you can show those to them. It's important to keep everything in order. So more than just having access to a line of credit, you also want to make sure that your assets are listed for insurance purposes. Now, not having a bookkeeper. And yes, I mentioned that at a high level up here in mistake number 5, but I want to make sure I make a statement out of it. Having a bookkeeper, it's very important. It's more than just you downloading a software from QuickBooks and just snapping a picture of the receipt and just let your accountant do magic. No, like that is a very, very bad practice. You want to make sure that you have a bookkeeper, whether in-house or whether you hire an accounting firm that offers bookkeeping services, because you want to be monitoring your company books at least on a monthly basis. You want to make sure what's working for you, what's generating sales, and whatever's not working, maybe it's time to move on. Maybe it's time to get rid of it. Same thing with the expenses. So if you don't check your books on a monthly basis, how are you going to know that you're losing money somewhere, that you're losing money because you're paying too much of an expense, or that you're losing money because you're allocating your efforts, your staff, to a service of a product that there's no demand in, or that it's not working for you? So having a bookkeeper will allow you to look at those numbers on a timely manner, so that way you can make promptly and timely decisions that will help you not only save money, but also generate a lot of money in the long run. Now, moving along, mistake number 7, not reporting any income in your company. Okay, this is one that I hear over and over again. I've read countless of comments in the channel from people saying, well, I make a lot of money and every time I go to the bank, they don't want to lend me any money, or I cannot seem to get a mortgage approved, but I make a lot of money. Well, just think about it this way. And I know that paying a lot of money in taxes hurt, but you can have the whole cake, right? Something's got to give, for lack of a better term. You can't just not pay any taxes and at the same time go to the bank and get a lot of money, right? And just to illustrate the point, not reporting any income in your company works exactly the same way with you on the personal side when you're trying to go to the bank and get access to a loan, right? So I've mentioned countless times in this channel that the bank typically issues a mortgage based on how much money you make. So they typically give you 3 to 4 times your income. So on the business side, it is very similar, with the difference that the lender or the bank is focused on net income, not gross. So let's say, for example, you run a very successful business and last year you generated $1 million, right? However, in terms of expenses, you reported $970,000, which means that your net income, it's only of $30,000. Is that good? Is that bad? Well, it depends on how you look at it. $30,000 could seem good because you're paying some taxes, but not so much. But guess what? Your lender is gonna base your loan according to your net income. So that could be one of the reasons why you're not getting approved a certain amount, because you either reported very low income or you just reported no income at all because you didn't want to pay taxes. So when you do that, you're limiting yourself and the amount that you can receive. And just a bonus tip on this point, remember where I talk about assets and stuff like that right up here? Well, this also has a lot to do with this. Why? Because at the time that you apply for a loan, the bank, it's going to look at your net income because they want to see how much cash flow you have. And if you have good assets recorded in your books, then you could improve your chances of getting a higher loan amount. Because remember, in the event that you cannot pay, they can go after your taxes. But Always keep that in mind. Net income, cash flow is king. The lender wants to know that you have some cash sitting in your account to pay that loan back in the event something happens with your business. That is the reason why every time you go ahead and you apply for a loan, they ask for a balance sheet, because on the balance sheet is where you see a list of all of your assets. And they also ask for a profit and loss statement, because in that profit and loss statement is where they will get to see the net income, how much money you have left after you have paid all of your expenses. So very important to keep that in mind. Now, moving along to mistake number 8. But before we do that, if you're enjoying this episode, do not forget to hit the like button right here so you can help this episode rank and help others like you looking for information of this kind. And that is not getting a company credit card. Did you know that there are plenty of advantages of having a company credit card? Well, for once, you have access to higher limits. So that means you get to spend more money. Well, of course, if your business is new and you have less than 2 years, chances are you're going to get approved for a card with a slower limit. But then after that 2-year period, once you establish yourself in the business and you prove that you have liquidity, that you have a successful business, you can request for that limit to be increased. And it typically tends to be higher than your personal credit limit. And in addition to that, did you know that having business credit does not impact your FICO score? That means you can use more on that credit line that you have without the fear of having your FICO score negatively impacted. So those are two of the major advantages of having access to business credit. And for those who are brand new to the channel and have never heard about the differences between business credit or personal credit, here's a video that you can check out after this one, of course, that's going to explain you the differences between the two and why you will prefer one over the other. Okay, now back to the list, and we have mistake number 9, and that is not taking advantage of the SBA. Okay, so for those who don't know, the SBA stands for Small Business Administration. And they're a cabinet that represents small businesses in the United States. And they offer you training, they assist you with business plan and stuff like that. And they also back up a lot of the non-conventional loans for small businesses. So what makes a loan non-conventional? Well, let's say, for example, typically when you want to apply for a business line of credit, the banks is going to request that you have at least 2 years of business tax return, right? Not personal, business tax return. Okay. And if you're fairly new, let's say you've had your business for a year and a half and you're already seeing the potential and you want to expand to the next level, sometimes the lenders might not want to take that chance with you because you don't have 2 years of tax return to prove that you are a stable business. And that's when the SBA steps in and they back up some of the loans so that the lenders feel more comfortable loaning you the money. As you can see, the SBA is not just stimulus money. And I know that during the pandemic, the SBA name was, surely out there because everyone kept talking about the PPP loans or the EIDL loans and all of those loans that were part of the rescue package to assist businesses during the pandemic. But the SBA doesn't just do that. They're not only a stimulus entity, but they come in and they've been around for quite some time now. They've been around for decades, helping more businesses grow to the next level. So for those who are interested in taking out an SBA loan, all you got to do is just to simply walk into your local bank and ask them, hey, do you offer any SBA loans? Chances are they're going to say yes. And then you're going to ask them, hey, who can I talk to? How can I learn more about it? And if your bank doesn't offer any SBA loan, then ask them where you can go to get a hold of an SBA loan. And chances are you'll be surprised to see how many lenders in your area are offering SBA loans. And now that you're here, remember I talked about a bonus at the beginning of the video? So that bonus mistake, which also translates to a bonus tip. One of the mistakes that businesses tend to do that affects their finances is not having their taxes, business taxes, right? Handy, okay? Remember, Every time you're gonna take advantage of OPM, other people's money, every time you're gonna go to a bank, every time you're thinking about requesting a loan, the bank is gonna wanna see how stable have you been over the last couple of years. Usually over the last 2 years, sometimes depending on the loan, maybe even 3 years back. So make sure that you have your business taxes handy and ready, meeting all of the criteria that I talked about so far. So that way you can save time and then just hand over those documents to them and help you expedite that application process so that you can get access to capital quickly. Now, for those who are interested in learning about the Dun & Bradstreet, where you can go, how you can interact with them, how do you create an account with them to build business credit, here's a video on the site that you can definitely check out and answer all the questions you can possibly have. So I'll see you in the next video. Take care. Bye-bye.